Hello, good evening. How are you?
Good evening, sir.
Welcome to the class of financial reporting.
Yeah, thank you, sir.
Okay, no problems. Okay, before starting, I would like to know that what have you studied and what are you doing? I mean, as far as the job is concerned, so that I may have an idea, so that we can resume accordingly.
Yeah, so I'm currently a senior associate at Cloud Company. So
Okay,
yeah, and I have been failing this paper like for 5 times, I think. Yeah, and got the tuition as well. So I studied it, but now I'm redoing it this year. And I do have a background accounting as well. So I've been working as an auditor for the past 4 years, 5 years, and now I'm doing accounting. So like an accountant on a company. Yeah.
okay. And did you happen to give the paper in the December attempt or in the March attempt?
No, much no. No, it was last year.
It was last year. And when was the last time that you did attempted the paper?
It was in September.
That was in September. Okay. And how many marks did you score?
It was 40, 44. I think.
Okay. 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 And were you able to complete your paper at that time?
Yeah, I was able to complete, yes.
Okay. Despite of completing the paper, still you were able to get only like around 40 to 44 marks, right?
Yeah, so my weakness is on the ratios, like the section C.
Okay. Okay.
Yeah, on the ratios and the
No problem.
consolidation.
Okay.
Yeah, the consolidation is
Okay.
fine, but uh, if ever we got the financial statements to do, like a balance sheet or P&L, instead of a consolidation, yeah. And I think there are many adjustments on that area.
Okay. Okay. No problems. No problems. I'm kind of like, if I talk about myself, I don't want to blow my own trumpet or something, but it's just that I kind of have the speciality for the students as well who are unable to pass the paper in the first attempt. So technically, it's a good thing that you are over here in my class. Now I'll be guiding you through the rest of the course as well regarding your weaknesses as well, and plus we will be doing everything comprehensively. But one thing I would like to mention you over here that while preparing for the paper this time, what you have to do is you have to totally forget that you have attempted this paper for like 4 times previously in the past. Just forget everything about that, what you have done in the past, okay? This is going to be a fresh start for you. And all you have to do is, obviously at times with the job as well, it kind of becomes a bit of a difficulty as far as giving the time to your studies is concerned. So you have to come up with an idea or a plan where you can give the proper time to your paper as well. And talking about the proper time, what I would say to you is, in the start for like around couple of months, it's more than enough if you spare 1 hour daily for your this FR paper. In the first couple of months, 1 hour is more than enough on daily basis to give to this to give to this paper. And during that 1 hour, what you have to do is you have to totally forget about your job. You totally have to forget about your cell phone as well. While when you are studying and you're sitting and you are preparing for the paper, or you're practicing, or you're revising the concepts, all you have to do is you have to totally forget everything and then sit for the paper. Because if you are keeping if you keep on using your cell phone, if you are keep on watching the TV, or if you are keep on doing the other course as far as while studying is concerned, then it's not going to help it. then 1 hour is not going to be enough. Believe me, I've been through this, and me myself, I've been into the teaching since 2005. So it's been like kind of like, more than around 17 years or so. I've been into this teaching and all. And this financial reporting, SBR, financial accounting, basically the accounting itself, if we talk about, these are my specialty. So what I will be doing is that I'll be like, taking along the course during the way, and I'll be guiding you, and I'll be providing with you with each and every resource that you require. And I'll make sure this time, no matter what, however, like, the things done and upside down or whatever the thing is, it is my responsibility this time that you will be passing your paper. So any of the papers of the ACCA that you're opting with this, or only you are going for the financial reporting?
No, so I'm going for financial management as well for this September.
Okay, and what about the audit? Is it clear? Already you have passed the audit paper?
Yes, post the audit paper. Yeah,
Okay, and when was the last time that like, when did you pass this audit paper?
it was like 2 years ago.
Okay, 2 years ago. So
Yeah,
it's
it was
like,
audit and tax. I posted.
okay, okay. So it's like that you have been taking a bit of a break from the ACCA, right?
Yeah, you're right because of workload.
Yeah, because of the workload and all, you've been taking the break as well. Anyhow, the break is a good thing as well, because at times when things are not like, kind of going in and moving into your way, it's a good sign, and it's a good thing that you take a break for a while or something, and then you revive and you bounce back like, like never before, and then you are able to easily like, compete with this, and you are able to like, do well for as far as the paper is concerned. Anyhow, we'll start, and talking about the paper, let me just share a bit of a documents with you. This is something. Okay, first of all, I'll be talking about the format of the paper. This is kind of something like, you are already familiar with. We have in section A 15 MCQs of the 2 marks each. It's going to be 30 marks. Then in section B, we are going to have three scenario-based questions, and these are going to be of the 15 MCQs in total. Obviously, 5 MCQs per scenario, one scenario, and these are going to be of 30 marks each. And then we are going to have two scenario-based questions as far as the section C is concerned. So the total is obviously 100 marks. And talking about section C, section B, or section A, all of the sections are important as far as scoring the marks is concerned. But again, as you have mentioned, that you feel that this section C is basically the area where you are kind of like, not much prepared, or you think that maybe this is the vast area of the syllabus as far as the paper is concerned. Now, talking about the stuff, talking about the paper, I have to make one thing very clear, and that is I will be the one who will be providing you with the notes, exam kit, the book, each and everything you are going to have from my side. All from your side I require you is to have the practice as and when I ask you to. Okay, this is the maximum, this is the maximum what you can do, and this is the maximum thing that you should do. Okay. Okay, we have another student. I'm sorry if I pronounce your name wrong. It's Hofstad.
Yes.
Okay. Miss, can you tell me about yourself? What papers have you passed, and what like, papers this time you're opting, and if any job or something you're doing?
Yes, I'm already done with level 1 and level 2. I remain F7 and F9.
And these are going to be your first time you're attempting these papers.
Yes.
Okay, and how much did you score in the financial accounting, and when was the like, the time when you attempted that paper?
It's already 5 years ago. It was maybe around 64 to 60, 60, 64.
So, talking about yourself, if it's like, kind of around 4 5 years ago, and then we have the I wish your name is Ivish, right? I'm
F
sorry if I'm
F8
pronouncing it wrong.
F8 I have done with Mr. Hamza itself.
Okay. And when was the time when you attempted the paper?
3 years ago, a bit long.
Okay. Okay, it's been a long as well. Okay, for both of you, it's been a while that you've been in touch with the ACCA, or as far as I would say, it's been a while since you have been in touch as far as the accounting paper is concerned. So I am going to assume that your knowledge regarding the accounting is zero. I'll be bringing you up from the scratch. We will be doing everything from the basics, and I will make sure that each and every concept is being delivered to you and is being conveyed to you as a fresh, and it's from the total basic knowledge we will be bringing up the things. Okay, this is what my approach is going to be as far as your paper is concerned. So you don't have to worry about if we are into the basics of something. You don't have to think and worry that we are into the basics of something, because once your foundation, once your basis is strong, only then you will be able to build up, only then you will be able to construct the whole building of the financial accounting or the reporting on the foundation which we are going to build in the coming weeks. So all you have to do is, like I was telling to I was before, before you joined, that for the first couple of months, only one thing is required from your end, and that is you have to spare 1 hour for your studies, for your financial reporting paper. If you are opting, or if you are going for another paper along with the F7 or something, then obviously you have to spare 1 hour each for each subject. That is the maximum time, or that is the maximum allocated time for a subject. If like around 15 minutes, 20 minutes, 30 minutes, you think you are done with the whole class work, or you are done with the whole revision of the week, it's fine. You can close down your books and you can do whatever you want to. But you have to give a maximum time of 1 hour daily. It's on daily basis. This is the maximum time I'm requiring from your side. And believe me, if you want me to, I can write it down on a piece of a paper for you, that if you spare 1 hour daily and religiously to your financial reporting to your F7 paper, I can write it down and I can bet it with you that it will be very easy for you to pass the paper. Because I've been talking to the other students, and I was saying that the same thing. Basically, it's kind of my specialty, specifically for those students who unfortunately are unable to pass a paper in the first attempt or something. Because I kind of go in that way, or my approach is kind of, my tone is kind of been set in such a way that we, or I personally speaking, I normally have the specialty where you can say, I'm not finding the exact word to say, but I kind of easily identify the pinching points as far as the knowledge is concerned. I know how to hit the pinching points for the knowledge where I know that the extra effort of the student should be there. Right now, a portal is going to be created where you are going to have all of the notes, all the exam kits, every step from my side which is required to you. You will be having over there. All you have to do at your end is go through those, try to be regular in the class, and if due to unforeseen reason, or unavoidable reason, if you have to skip your class, you have to make sure that the next time when you're coming into the class, you are totally done and dusted with the recorded lecture as well. This is going to be very helpful for you. And again, the WhatsApp group is going to be created as well. I'll be there on the WhatsApp 24/7 for you. And one thing you have to do is, when you are studying, even if it's 3 p.m. or even if it's 3 a.m., if you have a question in mind regarding any step, question step, or any concept or anything or any question, just drop me a message onto the WhatsApp, and I'll be more than happy to assist you in that, and I'll be more than happy to guide you regarding what to do and how to do it. Okay, I'm more than happy to assist you in that, either by replying the text in a simple, in a text format, either replying you guys via a voice message, either replying you guys with a short video, whatever thing I think, or whatever thing, or by whatever means I feel that it should be conveyed to you, or it should be answered to you guys, I'll be assisting you through the whole of the course. But again, obviously, asking the questions and making sure that everything is clear to you is kinda at your end. It's at your end that you have to ask me. It's at your end that you have to go through the work, you have to go through the practice and everything, and then you have to ask me. And I'll be more than happy to assist you in that, right? I don't mind getting the text from you late at night or something, because I'm kind of up myself as well. So I'm kind of working late as well, because my work commitments and all. So technically I'm up and always having the phone with me. So this is something you can try on a hit and trial basis as well, just to check if I reply or not, right? This is something you can always check, and this is something, if I am saying it by my own self, that I'll be available over there as well. So this is something you can always check, and this is something you can always ask from your the previous students which I had in my class recently, around 4 or 5 students of the from the Hamza Academy were over here from the Mauritius, who actually attempted in the March attempt basically. And this is something, believe me, it's not me who is saying, you can confirm from them. And every single student, every single of them, they pass the paper in the very first class. And two ones basically for the kind of repeated exams around 30 right. And the average marks basically, I was kind of calculating just before this class, and the average marks is like around, I guess, 62 or 64. So if average marks are kind of standing at 60, 64, it's a good thing. So it is technically still achievable. The paper itself, it's not difficult, it's about the concepts. It's about the concepts that you have to build. And technically, again, if you go through the examiner reports and all, the examiner explicitly always points out regarding some of the points that normally students kind of fumble upon. And this time the examiner has been pointing out towards the final accounts, basically the question which was over there in the paper. So it was a bit of a difficult, not difficult but technical one, so the students kind of had a problem in that. But again, it's okay, no problems with that. And now I'm kind of expecting, as far as your attempt is concerned, I'm kind of again expecting that in section C, you are going to have a question of final accounts, not of consolidation, but of the final accounts. But again, this is something which I am expecting. It's not necessary that it's going to happen or something, but let's see. Till we are alive somehow, we will kind of look into that. I will be providing you with the exam kit of both the BPP and the Kaplan. The BPP exam kit is going to be the standard one, which we will be following in the class. But I will be giving you the Kaplan exam kit as well. That is the one that you will be doing at home. And if you have any difficulty, any problem, or anything in that exam kit, you can always text me. You can always by coming into the next class, you can straight away ask me that, sir, this is the question, the exam kit of the Kaplan or the BPP, and this is the question number which I have been kind of having a difficulty as far as understanding the concept or understanding the calculation is concerned. So I'll be here to assist you in that as well. Done. So these are the points which I had to kind of discuss with you in the very first class, and these are the points which I always kind of make sure that I do forward over here. And now, apart from this, if you guys have anything or any point that you guys want to ask, discuss, or add, you guys can. Otherwise, we are good to go to start formally with our course. And at the end of each class, I'll be the one who will be uploading my lectures, to the Google Drive as well. I mean, the lectures means whatever slides, whatever Word file I gonna use or I gonna have over here in my class, they will be uploaded over there as well, so that you guys can have an idea about what I am doing and how it's done. Okay. So, talking about from where to start, this is going to be regarding the tangible non-current assets that we have to start from. This is going to be about the tangible non-current assets from where we are going to start and we are going to have the discussion about. Now, talking about a tangible non-current asset can only may only be recognized if. Now, talking about a tangible non-current asset, if we say, before moving towards like how it is recognized or what's the recognition criteria and all, let's just talk about what is a tangible. A tangible is something having a physical substance or existence. A non-current asset is an asset whose benefit is for more than one accounting period or whose benefit is for more than 12 months. So technically, a tangible non-current asset is an asset with a physical substance or with a physical existence, right, whose benefit is going to be for more than 12 months. This is going to be called as the tangible non-current asset. And a tangible non-current asset may only be recognized if its cost can be measured reliably and it is probable that the future economic benefits will flow to the entity from the asset. And talking about the initial valuation, it's going to be at the cost. And the cost is going to be the purchase cost, subsequent expenditures that adds to the asset, plus the cost of replacement parts if old parts are accounted for as a disposal of assets when they are replaced. And repair and maintenance costs or the revenue expenses, they must not include the cost. Now, we have talked about the basic points as far as a tangible non-current asset is concerned, that how to recognize it, how to account for it as far as the accounts are concerned, what's the cost and everything. Now, again, I will be switching back and I'll be taking you to the Word file where I will be writing about this, and this is going to be the cream which you are not going to find in any of the book or in any of the notes or whatsoever. So this is IAS 16, property, plant, and equipment. IAS 16 deals with property, plant, define property, plant, and equipment as asset held for production, for supply of goods, for rental to others, or for administrative purposes. Now, asset held for production, your plant, machinery, for supply of goods, delivery vans, forklifters, etc. For rental to others, for example, rent a car, bike, house, generator, building, everything, these sort of kind of things. And then for administrative purposes, your infrastructure is going to be over here. Okay, so this is what basically IAS 16 or the property, plant, equipment, the tangible non-current assets are. Same case that if you have an asset for the production or for the sake of the production process and all, for example, your plant, your machinery. Now look at the examples. The plant, the machinery, all are tangibles, and technically all have a benefit of more than one accounting period. For supply of goods, delivery vans, forklifters. Now the category of the assets which are on wheels, the category of the assets which are on wheels is straight away combined and written under this one line. For example, if you have the car, if you have the bike, this is going to be under it as well, despite of the fact that if it's used for the supply of goods or not, right? For example, the delivery vans, forklifters, etc. For rental to others, if you have a tangible non-current asset, if you're renting out to some other persons or something, then it is going to be regarded as the IAS 16. For example, if you have a rent a car, you have a rent a bike, you have a generator, you have a building, or you have a setup where you are organizing the events, and you are using that setup for organizing the events or something like the canopy and all, the events normally, or the wedding events normally, which we see being done in some in some open space, like in the grounds or something, where they have installed the canopy, where they have the stage as well, the chairs, the tables, everything, everything, right? That you kind of see and come across, these are going to be into this. And then for administrative purposes, the whole of the infrastructure of the building. Talking about the infrastructure of the building, obviously the building itself, then the electric fittings of the building, then obviously the lighting backup or something, if there is any, this is all going to be into the property, plant, and equipment. These are all the assets or the tangible non-current assets that we have to talk about over here. Done. And then coming ahead from here, we have initial measurement. Initially, all non-current assets are measured at cost. That initially all non-current assets are measured at their relevant cost. Now, what's the cost? All the expenses being incurred in bringing the item of non-current asset to its present location, condition, and expenses incurred so as to bring it to its intended use. All the expenses being incurred in bringing the item of non-current asset to its present location, condition, and expenses incurred so as to bring it to its intended use. That all the expenses that you incur from buying the asset to bring it to its intended use, for the sake for what you have bought the asset for, all the expenses that you incur on the way to bring the asset to its intended use, they are going to be capitalized in its cost. For example, let's have a basic example first. Like it's very hot and humid over here in Pakistan. Similarly, it's gonna be, although the Mauritius is kind of an island country, the weather over there is normally tropical and all. It's a very personally, but the thing which I like about Mauritius is the cool, the cool air or the cool breeze that we have in every evening, and that is the best thing which I like about Mauritius, having onto the being onto the side of the sea and everything. But again, over there as well. Let's forget the accounting for a while in this example, and let's just talk about a main example, a daily life example that we have around us. Now, it's hot and humid, right? And we kind of feel very low and down when it's kind of hot. So we decide to buy an AC for our home, right? So you went to the market and you decide to buy an AC. For example, you go and you buy a 1.5 ton AC, right? You buy an air conditioner for 1.5 ton being the size of the AC. And assumingly, I don't know what's the cost of the ACs over there or something. Let's just assume that it's kind of around, not the dollars. Let's just write this in rupees. Same case, this is for 100,000. I'm just giving you the example over here for regarding the Pakistan. I'm just giving this example just to guide, just to guide, to clear you guys that what's the cost is or how the cost is basically calculated. So you buy the AC for 100,000. Now you have bought the AC, right? And it's sitting at the shop, right? It's in the boxes, it's totally packed and all. Now, why have you bought the AC? Because you kind of feel hot and humid and you kind of feel down during the, the summer weather, and you wanted to have it installed in your house so that, when you turn on the AC and it's blowing the cool air, you are kind of feeling okay and a kind of fresh as far as the summer is concerned. So from buying the asset, you have just bought the asset, but it's still in the shop. You have to bring it to your home. So now you incur a delivery cost. Same case, you had to incur 1,500 for the delivery. Now you have incurred the expense where you have brought the asset to the present location. It's buying cost and it's delivery cost, but it is still packed in the packs, right? It's still packed in the boxes. Now you incur the installation. You pay around 25 the installation. Similarly, there is an electrical surge over there in Mauritius that we have over here in Pakistan as well. So you decide to install a circuit breaker switch so that when the electricity goes ups and downs, your electric appliances are kind of safe because of the circuit breaker and all. So you install that switch for like around 1,000. Now your electrician turns on the AC and suddenly the power goes out. Your electrician turns on the AC and suddenly the power goes out. After a couple of minutes, while sitting here and there, your electrician observes that it is only your house where the electricity is not coming in the whole block or in the whole street or something. It's only your house. So he checks the main switch and it's kind of tripped. He turns on the main switch on to on, and he turns on the AC again. Then again the main switch trips. He tries this for 2 or 3 times, and after checking, with a big smile on his face, he says, "Sir, you have a single phase wiring in your home. You have a one single phase meter in your home, and to run this AC, you have to have a three-phase meter. Your electric connection does not support this AC. Now, you have brought the AC to the present location. You have installed the AC on the wall as well, but expenses incurred so as to bring it to its intended use. You have not you have not bought the AC as an as a decoration item or as a scenery or as a picture to be hung on the wall. You brought the AC because you wanted it to to throw the cool air while in the summer. Now you incur the cost for a three-phase meter. Same case, you spend like around 30,000. Now after installing a new meter and everything, now you turn on the AC and now the AC turns on and it starts blowing the cool air. Now your expense regarding the AC is going to be totaled, and according to the rules of IS 16, its cost is going to be totaled over here. This is what the rule is, that no matter what expense you incur, you have to capitalize it, you have to add it up into the cost of the asset, right? This is what the definition is saying, that all the expenses being incurred in bringing the item of non-current asset to its present location, condition, and expenses incurred so as to bring it to its intended use. Now, for a person like me who is kind of an accountant and as well as a bit of an engineer as well, I kind of think, and I have a question in my mind, that when I have installed this three-phase meter, this electric meter or this electric meter connection is gonna be used by the other appliances at my home as well. For example, if I already have a TV, if I already have a fridge, a microwave, an iron, or something, they all are going to share this meter as well. So, why to capitalize the cost of this meter into this AC only? Why not to capitalize it separately or something? When I have this question in my mind, another scenario automatically answers me this question, and it is that this already TV in your house, this already fridge in your house, the microwave or the iron or the washing machine or anything, all the electric appliances that you have in your house, they were already there before you bought the AC. They were already being used on the single phase connection, right? You had to bought this like this meter and everything so as to run your new AC. This expense has been solely and explicitly incurred because of this AC. So that is why it is kind of capitalized. This is kind of added into the cost of this AC. This is the basic rule why we are capitalizing the cost of the three-phase meter. Now, let's just talk about another example where we are importing a machinery in our country. Okay. Now we are importing a machinery. So machinery's list price is going to be capitalized, and this is going to exclude trade discount and refundable taxes. We are going to capitalize the list price, and then we are going to exclude the trade discount, and we are going to exclude the refundable taxes. Now, a quick, refreshing concept in our mind that what's the trade discount? The trade discount is the discount that is available at the spot, on the spot, or it is called a bulk discount. This is called a bargain discount as well. And this is the discount that you kind of end up taking up from your supplier when you are buying some stuff or something. Like, for example, if you go to the market and if you look at a thing or two, and then you kind of tend to do the negotiation with the supplier, and the supplier at the end of the negotiations drop the price by a certain amount or something, that is called as the trade discount, right? That is a bargain discount or a trade discount or a bulk discount as well. So whenever we have to pass an entry in the accounts, whenever we have to enter the values into the accounts, remember the amount is always entered after netting off the trade discount, because technically speaking in the accounting the trade discount is never ever recorded. The trade discount is never ever recorded. For example, you go to the market and you tend to enter into some, the garment shop or something, and there is a sale. There is a kind of sort of a sale at the end of the season or something, or that is a sale because of the Easter or because of the Christmas or something, right? And you kind of see, or you kind of look at some of the products, and there's like around 20%, 40%, or 50%, off on it, right? Now, when you buy a shirt or when you buy, some pants or something, obviously if there is an off on the price, technically speaking, what happens? You pay the amount that is after the discount. It never happens like, if say in case its original price was at 1000, after the discount this is at now at 600. It never happens that you pay 1000 for the cost of the shirt. The shopkeeper or the guy at the store takes the 1000 and then returns you the 400 by saying, look, here it is your discount, have your discount back. It never happens, right? You always pay the amount that is after the trade discount, right? So technically speaking, the trade discount is never recorded in the books. Now, talking about the refundable taxes. Now, you got or you bought an asset on which obviously you have to pay the tax as well. Now, if you are registered with the tax and the tax which you have just paid on acquiring the goods or acquiring the asset, and according to the rules of the tax, that tax is refundable. That tax is refundable. Then you are going to eliminate, or you are going to deduct the amount of the tax from the product, right? You are going to deduct the amount of the tax from the product. For example, uh, let's just say price of asset is 20,000, tax is 10% and is refundable. The double entry that you're going to do is you are going to debit the asset with 20,000. You are going to debit the tax with 2,000. And then if you have paid the cash, you are going to credit the cash with 22,000. You are separating the tax over here, and this is separated over here as a refundable, as an asset. This is recorded as an asset over here. Done. You are recording this amount of tax which you have just paid as it is refundable. You are going to record it separately. And if the tax is not refundable, you are going to debit the asset with 22,000 and you are going to credit the cash with 22,000, where the tax is not refundable. You are going to add up the tax into the value of the asset where the tax is not refundable, right? Okay, I hope it's clear to you guys. So we have kind of cleared that we have to exclude the trade discount and the refundable taxes. Now, obviously, as we have bought the machinery from overseas, we have to bring it into our country. So we are paying the import duties on it. Fine. So the import duties being paid, they are going to be capitalized. And okay, this is going to be duty, not duties. Okay, now, apart from the import duty, this is the rule of the international consignment that if your assets value is US $50 or more, it is a rule of the international consignment that if your assets value is $50 or more, you have to go for the insurance. Now we have an insurance cost. Now the question comes, should we capitalize the insurance cost or not? Should we capitalize the insurance cost or not? Not. Miss Ali, what do you say? What do you think? That should we capitalize the insurance cost? Miss Ali, you there?
Yes, sir. I think yes, we should be capitalizing the insurance cost.
And why do you think so? Why do you think so?
Because it's a cost being incurred when we are bringing the asset to our country. So we are paying for that money.
Okay, done. Okay, one more thing. How do you pronounce your name?
It's L, Lovish.
It's L. Okay, Lovish. Okay. I thought it was a capital I. My bad. I'm sorry. Okay, it's Lovish. Okay. I'm sorry for pronouncing it wrong first. Okay, I got it now. It's L. I thought it's a capital I. Okay, Lovish, I got your point. Now we have another student, Miss Annie. Miss Anne, sorry.
Anne Sophie.
Anne Sophie. Okay. I hope you wouldn't mind if I call you Sophie only. I'm sorry.
Okay.
I'm sorry for pronouncing your name wrong. Okay. What are you saying? What's your say regarding the insurance?
It should be included.
Okay. It should be included, and why is it? Because we have read
as it is bringing back the asset to value.
Okay. You said as it is bringing back the value to the asset.
Yes, we are importing the asset. It is if if the insurance is not there, um, if either we get problem, then we will not be able to add it.
Obviously, I mean, without insurance, we won't be able to import it, right? Okay.
Yes.
Now, my other question. Do you mind explaining what insurance is?
Insurance is a guarantee given if either the goods is damaged or lost,
Okay,
then
wait. You have to be over here with me. You said insurance is a guarantee which is given to us, and then when you use the what word?
if either the
Huh.
goods or asset,
Wait again. You started off your line with the saying, if the
ever,
goods are lost or something, right?
yes,
You are using the word if. Now remember this word, Ms. Sophie, you said if the goods are damaged, right? Lois, you have to keep
yes,
this if word in your mind as well. Now, you said if the goods are lost, if the goods are damaged, we are going to have the claim from the, the insurance company, right? Now, my
yes,
question, if there is no loss, there is no damage, then what?
it is not refundable.
It is not refundable. So we are standing into the land of if and buts. That if something happens, we are going to have the refund. If that happens, we are going to have the refund. But if this or that doesn't happen, it's not going to be refundable, right? This is
Yes,
what the insurance said. Now, what is an asset? What is the basic definition of an asset? That when it is probable that economic benefit will flow towards the organization, it's called an asset, right? The basic definition, apart from the control, apart from the controlled economic benefits and all, the basic definition of an asset which we study or which we read or which we read in accounting is basically when it is probable that economic benefit will flow towards the organization, it's called an asset. Probable means when you are more than 75% sure about getting a benefit, right? The word probable, it means when you are more than 75% confirmed about getting a benefit from an asset is concerned. Now, asset says anything where you are having a confirmation of more than 75% that you're going to have a benefit is going to be called as an asset. But insurance, on the other hand, we are on to the if and buts. We are not sure. It's kind of 50-50, right? It's kind of onto the 50-50. So technically, by default, insurance doesn't meets the criteria of being called as an asset. The insurance doesn't meet the criteria of being called as an asset because if something bad happens, we are going to have the refund, otherwise it will be totally flushed away. By default, the insurance doesn't meet the criteria of the asset. So if something doesn't meet the criteria of being called as an asset, it cannot be classified or it cannot be added as an asset as well. It cannot be classified as an asset because technically by default the insurance doesn't meet the criteria of the asset. I mean, God forbid, how many times in a day or in a week or in a month we hear that a consignment coming in, the plane got crashed or the ship got drowned or something? How many times do we hear? It's very rare. It's very less. I mean, as far as the mode of travels are concerned, still the air travel is the most safest one, right? So the insurance by default doesn't meet the criteria of being called as an asset. So if by default it doesn't meet the criteria of being called as an asset, we cannot record it as an asset. So technically, we cannot record the insurance as an asset, right? It cannot be called as an asset. So we cannot capitalize the insurance cost into the cost of in the cost of an asset, right? Now, moving ahead from insurance, we finally got our plant, our machinery or something in our country. Now we are going to have the delivery charges. These are going to be capitalized. Then we are going to have the installation charges. These are going to be capitalized as well, because you have to bring it into the intended use. I mean, without installing, you will not be able to use the asset as well. Then we have the testing cost. Now, what is the testing cost? Testing cost is when you bring in your machinery, you install your machinery. Obviously, it's a machine. Before, making the commercial orders and all, you have to test the machinery if it is doing the correct work or not, if it is properly working or not. The standard says, the first testing cost is the cost that you incur for the first time testing your equipment or your machinery, that if it is working properly or not. And you do the testing by making the sample products and all. Now the standard says, till your production in charge and your quality in charge doesn't give you the green signal that the product which is being manufactured by the machinery is good to go and the machinery is ready for the commercial production, no matter you spend $1 or 1 million on the on the name of the testing, it will be capitalized as a cost of the asset. It will be capitalized as the cost of an asset, right? The first testing cost. Once your machinery is ready for the commercial production, once your plant is ready for the commercial production, there is going to be a full stop on the testing cost. Now, even if after a week, after a day of the commercial production beginning, your machine breaks down and then you tune up again, you test it again. Now, the second, third, fourth, fifth, whatever testing costs you are incurring, it is going to be flushed out in the income statement. Only the first time testing cost, when you get your machinery and you're kind of testing it, it will be capitalized in the cost of the asset. Once it's done, once your asset is fit, your testing cost will be finished, and it will no more be capitalized, or you cannot have it again into the income statement. So this is what basically the first testing cost is. Then we have training cost. Now, training cost. You got the machinery, you installed it over here in your factory or in your production house, and now you have to train your employees. You have to train your employees regarding how to use the machine, because obviously if they are not trained, then how will they use the machine? How will you get the machine into the intended use? Now the question comes, should we capitalize the training cost, or should we just expense it out in the income statement? What should we do? Lavish, you first. What do you say? What should we do with the training costs?
So I think it's like the testing cost. So the first training being provided to the employees, because we still don't know how to use the apparatus. So all expenses being incurred to bring it into use first should be capitalized, I think.
Okay, I got your point. Miss Sophie, what do you say?
Same. The first training should be capitalized.
Okay, fine. I got your points. Thank you for your contribution. Okay, now training cost. You said obviously we got the machinery for the first time. Our employees don't know how to use the machine and all. So technically we have to train them, right? Because without training, obviously they won't be able to think that how to use the machine and all, right? Now, talking about the training first. Training, can I call the training as an experience? I mean, basically you are training the employee now. so the employees basically get experience, right, on how to use the machine. It's their, like, it's their experience which is kind of like, building up, right? I mean, if you guys are having a training in your workplace or something, obviously while they are training you, they are giving you the experience of how to use a certain thing, right? This is a training, right? This is an experience, right? Okay. Lavish, you said that this is going to be kind of related to the testing cost, because this is the first time. Obviously, your employees don't know how to train and all, how to use the machine and all. So technically, we have to train them. Fine, you train them, and like after a week or after a month, 3 or 4 key workers of your machine, they left the job. 3 or 4 workers, key workers, the key operators of the machine, they left the job. Now you have got another 3 or 4 persons with you. Now, then the new guys, they don't know how to use the machine. Now you have to train them again. What should we do now? Should we capitalize their costs again?
No, I don't think so.
Okay. So at first, like, when you had to train, like, for the first time use, you capitalize the cost. But the second time you are saying, no, you don't think so. It shouldn't be capitalized, right? Now, training is an asset. Experience is an asset. There is no doubt about that. Training is an asset. Experience is an asset. Knowledge is an asset. There is no question. There is no doubt about that. But these are intangible assets. These are intangible assets. I mean, my training, my knowledge, my experience, these are assets. There's no doubt, but these are intangibles, because you cannot see the experience. You cannot see the training, right? This is a skill you get. The skill, the training, the knowledge, the experience, these are the some things you kind of experience. These are not something which can be like, which can be seen. They don't have a physical substance. They don't have a physical existence, right? So in the intangible assets, future economic benefit is probable, the cost is reliably measured, and the control is over there as well. But for the intangible assets, there is an other additional point, and that additional point is the intangible asset should have the capability of being separable. The intangible asset should have a capability of being separable. Now, can we separate the training from the employees?
No,
What do you think? What do you
no,
think, Lovett?
no, we can't separate it.
No, you cannot. I mean, the experience, the knowledge that you are getting in your job, obviously, at the end of the day, it's yours, right? The experience, the knowledge, like, the training, whatever you get at your job, it's your asset at the end of the day. Like, in the future, if you get a good offer from some other company or something, obviously you are going to leave the job and you are going to join that company. So technically, when you leave or when you go, you're going to take this training, you're going to take this knowledge, you're going to take this experience along with you. It's not a cap, it's not a lab coat, that if you are like, leaving, if you leave behind the cap, you leave behind the lab coat, right? It is something you're going to take it along with you. So if it's not separable, or something, it cannot be recorded, or it cannot be like, accounted for as an asset. I mean, just pause this whole standard over here, and let's just talk about like, Nike. Let's just talk about the Adidas. Nike or Adidas. I just said these two names. Buy Nike or Adidas. What comes in your mind? What comes in your mind? Their joggers, their sports shoes, their running shoes, their exercise shoes, their exercise clothes. So technically, at the end of the day, what is coming in your mind? It is is the sportswear that is coming in your mind, right? Just by saying the name Nike or the Adidas, the two top brands of the world as far as sportswear is concerned. But if you look at the financial statements of both of these companies, you are not going to find the name of the Nike as an asset into the financial statements of the Nike. You are not going to find the name of the Adidas as an asset into the financial statements of of Adidas. And that is, just hold on for a second. Okay, I'm sorry. Okay, I was saying, so in their financial statements, you are not going to find their names, the Nike or the Adidas. I mean, technically speaking, if you go to the market and if you're looking at the running shoes or something, so the Nike shoes on average is like kind of around like 70, $80, right? US dollars. Like kind of on average, they are at like around 70, $80. Even some are at like, more than $100 or something. But technically speaking, if I take the name or the logo of the Nike from the joggers or the running shoes, will you be spending this hefty amount on those set of joggers? Never. At least I won't, because technically speaking, if they are so of some like unknown company or something, I don't know about their comfort level. I don't know about their durability or something. So I will not be kind of comfortable in spending more than $100 on that pair of shoes or something, right? Because if I take away the name, if I take away the logo, their existence is ceased to exist. So technically, the experience knowledge, right? The experience and knowledge, the training. If I take it away, technically I cannot take it away from the employees, but even if I do, their existence will cease to exist. So the training, the experience, the knowledge, they are the assets, but they are the assets of the individual persons. And we cannot control the persons. We cannot control our employees. This is a very big statement I'm giving at the moment. None of a single organization in the whole world exists that can control their employees. None of a single organization exists. They can monitor them, they can have a check on balance on them, but they cannot control them. I mean, same case, on the Monday, you go to the job and you are kind of having a bad mood or you are kind of having a headache and you are unable to perform the way you normally do, right? No matter how hard your employer tries, if you don't want to work, you don't want to work. This is a simple rule of thumb. No matter how hard your employer tries, but if you are unable to perform because of your health or because of your mood or something, nobody can do anything. Your performance can be monitored, it can be evaluated, it can be checked, but it cannot be ever be controlled. So technically, if it cannot be controlled, again, the training, experience, knowledge, if the employee cannot be controlled, by default, the tangible non-current assets or the tangible assets, their definition is not met. So technically, if the definition is not met, again, then the training or the knowledge or the experience, they cannot be regarded or they cannot be capitalized as an asset. This is simple, right? This is simple. Again, it cannot be recorded as an asset over here. Then, so these are the stuff, these are the things which I had to discuss with you over here. As far as, so if we say that the category or the categorically speaking, what are the expenses that are to be capitalized into the cost of a non-current asset or not, then we have subsequent expenditure. Talking about the subsequent expenditure, if subsequently any expense incurred on a non-current asset enhances enhances the performance or increases the useful life, they will be capitalized. All else will be expensed. For example, repair, maintenance, part replacement, etc. Right? Now, subsequent expenditure, any expense you incurred in such a way that it enhances the performance of your non-current asset or it increases its useful life, they are going to be capitalized. Apart from that, any other expense incurred on the non-current asset, for example, the repair, the maintenance, the part replacement, etc., they are going to be flushed out in the income statement as the revenue expenditure. Okay, expense incurred by, where the performance is enhanced or something. That is something, for example, if you had a machine, if you had a motor in your plant or something, because of which at first it was producing 100 units an hour, and now you have replaced the motor, you have upgraded the motor by which now it is producing 120 units an hour. So the production of the units has been increased, the performance has been enhanced, so technically it is going to be capitalized. Similarly, you incurred an expense on your non-current asset in such a way that the useful life of the asset has increased. For example, you have a building and there's a new paint in the market that if you paint the exterior of the building with that paint, the deterioration or the wear and tear of the building decreases a lot, and because of which its useful life eventually increases. So that sort of a paint is going to be called as as a capitalized expenditure on the asset. So any added benefit because of the expense, any increase in the performance or increase in the useful life, they are capitalized. Apart from that, the repair, the maintenance, these are just to maintain the asset at the original performance level and all. Any such sort of an expense being incurred, they are going to be expensed out in the income statement. Part replacement means any part that is kind of being weared out, or that is kind of being damaged or something, and now you are just replacing the part with the same category and all. So that is going to be a replacement cost, and this is going to be charged to the P&L, or this is going to be charged to the income statement. Done. Then talking about the cost, over here we have another cost, and we have to talk about that as well over here on this point, and that is future dismantling cost. Future dismantling cost, or future uh, site restoration cost or something. So these are the costs that are now we have to talk about. And future dismantling cost or site restoration cost is a cost that we are supposed to incur at the end of the life of the asset. For example, we have installed our asset in in any area, or in any even if it's in our factory or something. Because of the use of the asset, the land where we have installed the asset is kind of getting contaminated. Or, for example, we are into a business of mining and we are digging the earth for the natural resources. So technically, if we are digging the earth, so there are going to be big holes in the earth, right? So the site restoration cost is, this is an agreement with the government and all, and this is an understanding that once we are done with the extraction of the resources, we are going to level off the land again, and we are going to restore it into its original form, into its original layout, the way it was before we started off the mining. So this is what the future dismantling or the future site restoration cost is. And for this, the standard permits, because as we have to use the site, and this is related to the use of the asset, this cost is related to the use of the asset. So what do we have to do is, number one, calculate the present value of the future cost, i.e., calculate the expense that you will be incurring at the end of the life of the asset. Once you have calculated it, then capitalize the present value of the cost in the asset and a corresponding what just happened. You are able to see the word again?
Yes, can see the word.
Okay. Okay. Capitalize the present value of the cost in the asset and the corresponding liability will be created. Then at each year end, depreciate the asset in the normal way and unwinding of liability should be done so that once you reach the end of useful life, you have a total liability ready against the dismantling or restoration cost. Now, this whole like understanding the future dismantling cost, site restoration cost, what you have to do is you have to calculate, you have to estimate first the total cost that you are going to incur in the name of the dismantling or in the name of the restoration. Then you have to calculate the present value. Then you are going to capitalize the present value of the cost into the asset, and a corresponding liability is going to be done or is going to be made. Then at each year end, you are going to depreciate the asset in the normal way, and there's going to be an unwinding of discount as far as the liability is concerned, so that the liabilities increase every year by a certain percent something, so that once you are at the end of the life of the asset, the liability is now ready with the full amount to restore or to dismantle the asset basically. Let's just have an example. The cost of the asset is 100,000, life is 5 years. At the end of year 5, total cost of 200,000 will be incurred in order to restore the site. The present value calculated at the discount rate of 10% is I don't have my calculator over here with me, but let's just have this value at 80,000. Done. Required. Show the necessary calculations and adjustments for the restoration costs. Now, we have an asset which is which has a life of 5 years, and at the end of the 5 years, we have to incur a total cost of 200,000 that is going to be used to restore the site, and the present value is calculated as kind of at 80,000. Now, what are the necessary adjustments that we have to do? First, debit the asset with 100,000, credit the cash with 100,000. Then you have this site restoration cost. Now you are going to debit the asset with the present value of 80,000, and you are going to credit a liability 80,000 as a future dismantling cost. Done. Now at the end of year 1, asset will be depreciated in normal way. Assets value is 100,000 plus 80,000 is 180,000. Depreciation charge for the year 180,000 by 5 is equal to, wait, 180 by 5 is 36,000. Carrying value of the asset is 180,000 minus 36,000 is 144,000. Now, okay, I don't know about this one. Let's just go from here. Insert table. Of Okay, we have the depreciation charge, and this depreciation charge is going to be 36,000. We have the asset at 144,000. Done. So the depreciation charge is going to be shown into the statement of comprehensive income, and this is at basically 36,000. Then we have the asset over here, and this is at 144,000. Done. And then now, as far as this liability is concerned, now for the liability portion, unwinding of discount is calculated. And let me show you this as well with the help of a picture, basically. Okay. Okay, this is year 0. This is year 5. Then we have the present value over here, and that is at 80,000, whereas at year 5, this is at 200,000. Done. Now, 1 year has passed. I mean, I hope you guys are kind of clear with the concept of present value and future value. If you have studied the F9 or something, or you're studying F9, then you kind of clear with the concept of the present value and the future value. The value that we have today is called as the present value, and the value that we are going to have in the future is going to be called as the future value. Let me give you a very brief understanding of this, and that is technically you have seen that the things day by day, they are getting expensive, and the currency is basically losing the value because of the inflation and all. Like, for example, 3-4 years ago, if you remember, a new iPhone or a new cell phone that used to cost like around $500-600, but now again the top of the line iPhone at this moment is like costing around $1,200 or $1,250, right? So I guess this is the amount. So uh, At that time, the iPhone was top of the line, the model that we had in the market like 3-4 years ago, and that used to cost like around $600 or something. And now again, the same iPhone that is now costing like around at 1200-1300. So the same iPhone's kind of top of the line, but the values are different. That is what basically the time value is. That is what gradually the things are moving towards being called as the expensive ones. For example, let me give you an idea about another concept apart from the iPhone, because we kind of think that the technology, the models, they're kind of different. So let's just get out of this problem and let's just talk about a Coke, right? You know, we all know about the Coca-Cola, right? The soft drink. Now, I'm just giving you the example of the Pakistan, the half-liter PET bottle, the 500 ml bottle. It was launched in the Pakistan like around 8-9 years ago, and at that time, it used to cost like around 16 rupees, 1/6. 8-9 years ago, when the Coca-Cola bottle was launched, 500 ml, it used to cost like at around 16 rupees, right? For 1/6 rupees. But gradually its price increased, and now the same bottle is costing around 55 rupees. Now, same bottle, same size, same quality, same taste. But the price at that time was 1/6, now it is 55. So the travel of amount from 1/6 to 55 is what the inflation is, and is what the time value of money is. And that is simple. A dollar one today is worth more and a lot than the dollar in the future. The buying power of the dollar, or the buying power of the currency, is basically like, decreasing. So now looking over here at this example, if we spend after 5 years in restoring the site, we will have to spend like around 200,000. We will have to spend around 200,000. But for the same site restoration and all, if today we think or we try to restore the site, it will only cost 80,000. If today we restore the site, in the present, it's going to cost us 80,000. But after 5 years, we do the restoration and all, it's going to cost us 200,000. So, like the work which we can do with 80,000 today is going to cost us 200,000 in the future. It's going to cost us a lot, or it's going to cost us more in the future. This is what basically the time value of money is, right? So we have to take into, or we have to account for the unwinding of discount, right? And now, how the unwinding of discount is going to be calculated, the value is going to be calculated, talk about. And talking about this, what now we have to do is we have to calculate the unwinding of discount. And how it is going to be calculated is going to be calculated into present value into 1 plus r whole raised to power n. R is discount rate, n is number of years. This is r and this is n. Done. And this is going to be present value. Today is 80,000 into 1.1 whole raised to power 1, and that is 88,000. So in year one, we are having the amount at 88,000. Done. So the difference is basically of 8,000. What we are going to do is unwinding of discount. The double entry is interest expense 8,000, and liability is credited with 8,000. So over here, we are going to have finance cost Done. And then we are going to have in the non-current liability. Let's just not go over here, just right over here. We have future dismantling cost, and this is going to be at 88,000. How? 80 plus 8. This is how 80,000 plus 8,000. And this is going to be increased every year. Done. I hope it's clear to you guys. If you guys have any question or something, you guys can ask me and I'll be more than happy to assist you over here. Done. Okay. Let's just take a break of like around 3-4 minutes. I just have to stretch myself, and like after 3-4 minutes, we are going to resume. Done. Let's just have a break. Okay, guys, I'm back. I hope you guys are back as well. So we were talking about the future dismantling cost, and we have just seen an example where we have to add up the present value into the assets cost along with the corresponding liability that we have to make. Then at every year end, we are going to depreciate the asset in a normal way, and then we are going to simply account for the unwinding of discount into the assets, into the liability as well that we have taken up for the future cost. Okay, now let me share my PowerPoint with you again. Okay, so this is the recognition we have talked about. Then we had the initial cost, the professional fees, the delivery cost, site preparation, assembly and testing. And then now we have the example of the initial cost over here. We have the site restoration cost. This is something which we have just discussed, and this is all over here into the slides. And this is the site restoration cost, and these are the provisions which we have just accounted for over here. This is the same example, or not the same example as far as the figures are concerned, but this is an example which you can see. And then now we have a complex asset, but we are going to pause this complex asset for a while because we are going to talk about something else for now, but we will jump back at this complex asset thingy again. Now, capitalizing of the borrowing costs. This is what basically we have to talk about as far as the cost of an asset or a cost of a non-current asset is concerned. Now we have the capitalization of the borrowing cost, and talking about the borrowing cost, this is IAS 23, International Accounting Standard number 23, relates with the borrowing costs. And what is the borrowing cost? Borrowing cost allows interest costs to be capitalized as a part of a cost of a non-current asset where the interest costs are directly attributable to the acquisition or construction of an asset, and the asset takes a substantial time to get ready for its intended use. Now, IS 23, this is a separate international accounting standard apart from the IS 16 that we are taking into account over here. And this standard is basically used, or this standard basically permits us to capitalize the interest on borrowings which we have as far as while acquiring the asset is concerned or while preparing the asset is concerned. For example, we take up a loan or we take out a loan, and from that loan, we finance the construction of our non current asset. The standard says the interest on loan on such a loan, which is explicitly used for the construction or the preparation of a non current asset, the interest cost is allowed to be capitalized. And normally, the interest cost, which is going to be capitalized, is related to the time period when the asset is taking a substantial time to complete. Like, for example, it's taking like around a year or so, or more than a year or so, it's taking time to complete or something, then that is going to be capitalized into the cost of the asset. And all we have to do is we have to calculate the exact amount of the interest that we are kind of sort of incurring on the loan, and that is going to be capitalized as far as the asset is concerned, and that will be capitalized basically. Done. So this is what basically the capitalizing or the capitalization of the borrowing cost is. Now just give me a second so that I may open a question where I can show you that how the interest cost basically works. Just give me a second and I'll open the question for you guys. Okay, now we are straight away heading towards our exam kit, because I want to give you an idea of about how the things are basically working and how we are basically taking into account each and everything. And this is the question 24 related to the tangible non-current assets. Obviously, it's an MCQ based question. And these are the couple of questions which we are going to do right now, so as to get an idea about how the things are going to work, or how, practically speaking, these are going to have an effect as far as what we have studied so far. So this is question 24, the very first question of our exam kit. This is the BPP exam kit. Say in case if you guys don't have the exam kits for now, you don't have to worry about that. You guys are going to have it in your portal, and then you can easily access and download the exam kits as well, along with the Kaplan and the BPP. Both of the exam kits along with the book will be available to you guys. For now, all you have to do is to look at the screens and look at the way I basically solve the question. So this is Foster Company has built a new factory, incurring the following costs: land, material, labor, architect fees, surveyors fees, site overheads, apportioned administrative overheads, testing of alarms, and the business rates for the first years. And then we have the question that what will be the total amount capitalized in respect of the factory. We have to calculate the total amount that is going to be capitalized in respect of the factory. Now, let me open my Excel, and here we go. We are into the Excel, and now we have this question over here with us, right? And let's have the currency signs here. Now, as far as capitalizing of the costs are concerned, we just have to capitalize what costs are going to be capitalized over here, okay? So first of all, we have the land for 1200. Then we have the materials at 2400. Then we have the labor costs obviously been incurred on the site. Then we have the architect's fees. The architect's fees is for 25. Done. Then after the architect fees, we have the surveyor's fee. This is 15. After the surveyor's fees, we have the site overheads. The site overheads are 300. Then we have the apportioned administrative overheads. Now, administrative overheads, these are the overhead costs that must have been incurred as far as the administrative costs are concerned, right? As far as the administrative, the costs are concerned, these are the overhead costs which have just been incurred. And talking about these overhead costs, or the administrative costs rather, administration cost or the office cost is the one which has been allocated to this whole factory which has been built. Now administration cost, it is going to be incurred no matter if you build the factory or not, right? The people working in the office, they are going to be get paid even if the building is constructed, if the building is being built or not, right? If the factory is being built or not. So technically speaking, this is a cost which will be incurred no matter what, if you do the construction or not. So these costs are not the one related with the construction, right? You have just apportioned a part of the administrative cost of the building, which you think has been been spent by the time, or the time and the effort being spent by the employees working into the administration department or something. So this is a portion of the cost which has been taken up from there. But this is something which you will incur no matter what. So technically speaking, it should not be capitalized as a part of the cost of an asset. Then we have the testing of fire alarms. These are at 10,000. Then we have business rates for the first year. Business rates, rent and rates. So these are the ones which you have incurred as far as for the business which are concerned, right? So these must have been incurred no matter, even if you have, if even if you have would have built the factory or not. And these are the ones which are not related with the cost of the factory. These are the costs which are related to the business running, or the running of the business cost is concerned. So these are not going to be capitalized as well. So the total which is going to be capitalized for now is going to be at 6950000. So the total is going to be at 6950. So this is going to be 6950, option B. So this is going to be option B of this MCQ. That is the cost which has been incurred as far as the capitalization of the factory cost is concerned, or the cost of the factory which is to be capitalized. So this MCQ is basically related to the definition of the cost which we have just studied as far as your question is concerned. Now we have question number 25. For now, let's just hold this question and solve this question first. Question 26. The borrowing cost thingy, which we have just read about, that this allows us to capitalize the cost of the interest that is over there as far as the construction of a non-current asset is concerned. We have taken up the loan and we are using that loan for the construction of the non-current asset, and then the standard allows us to capitalize the interest cost. Let's see this question. Electric company has borrowed 2.4 million to finance the building of a factory. Construction is expected to take 2 years. The loan was drawn down on 1st January 20x9 and the work began on 1st March 20x9. 1 million of the loan was not utilized until 1st July 20x9. So Leclerc was able to invest it until needed. Leclerc company is paying 8% on the loan, which can be in Electric company is paying 8% on the loan and can invest surplus funds at 6%. Done. Now we have to calculate the borrowing cost to be capitalized for the year ended 31st December 20x9 in respect of this project. Okay. We have taken up a loan, and this loan has been used as far as the construction of the factory is concerned. So we have to talk about this, how to basically do this question, or how to basically account for as far as the interest is concerned. Now, there are some multiple points that because of this question we are going to discuss first, which are over there as far as IS 23 is concerned. IS 23 borrowing cost allows you to capitalize the interest that is used to construct the factory, right? This thing's clear. Now, from when to capitalize? We start capitalizing the interest once the production or the construction of the asset starts. Once the construction starts, or the steps moving towards the construction starts, we capitalize, or we start capitalizing the interest cost. I mean, if we take up the loan at the start of the year, but we start off our construction around 5, 6, 7 months afterwards, then we cannot capitalize the interest for the 5, 6 months, the first 5, 6 months when there was no construction or whatsoever, right? We cannot capitalize. We start capitalizing the interest cost once we start doing the construction of the asset. Then the interest cost is eligible for capitalizing. It's not that you have taken up the loan and you are kind of sitting and waiting, or doing the planning thingy or something, that how you will do or what you will do. Once the actual construction starts, right? Once the actual construction starts, then you are eligible to capitalize it. And the capitalizing of the interest cost ceases. It stops. The capitalizing of the interest cost ceases or it stops once the asset is available for use. You have completed the asset, you have completed the construction, the asset is available for use, but you take around 3-4 months in order to switch the operations to that asset, or in order to bring that asset into your work or something, but the asset was available for use before that. So the interest cost is going to cease once the asset is available for use. You don't use the asset, it's your headache. You're not using or bringing it into the use, it's your headache. The standard says, because it's all about the accounting standards, the whole financial reporting is all about the accounting standards. So it has made up a standard, and it says that the capitalizing of the borrowing cost is going to stop once the asset is available for use. Point number 3, as we have seen in this example, as we've seen in this question, that you had taken up the loan from the start, and then you started off the constructing the asset, and obviously all of the money taken up for the construction is obviously not used. All of the money taken up for the construction is not used at the start, at the very beginning. Gradually you keep on putting in the money as far as the construction is concerned. So in the start, when you have surplus of the funds and you decide to utilize those funds in an effective way to invest them somewhere to get the return, then that investment income or the investment interest is going to be netted off from the interest cost, and a net cost of interest is going to be capitalized. For example, if you have 1000 and in the start you only need 300, and rest of the 700 is invested somewhere. So when it comes to capitalizing the cost of interest, the interest cost minus the interest income, the net interest cost will be capitalized, because you have used those funds to generate the inflows as well. So those inflows are going to be netted off from here. Like we see over here that we borrowed 2.4 million to finance the building. The construction is expected to take 2 years. The loan was drawn on 1st January and the work began on 1st March. So technically January and February, these are the 2 months when you were not doing the construction. So for these 2 months when you were not doing the construction, the interest cost of these 2 months is not going to be capitalized. Now, you used or you started to use the loan amount on the 1st March. You took the loan of 2.4 million, and 1 million of this was not utilized or not needed until 1st July. So from 1st March, April, May, June, for 4 months, you only used 1.4 million. You invested the 1 million excess. And then afterwards, from 1st July onwards, that 1 million was being used as well. Now, how to do the working? How to do the working? The working is going to be simple. First of all, we have borrowing costs, and the borrowing cost is going to be calculated like 2.4 million loan done, the whole amount is taken up, and the interest on the loan is 8%. We are going to have the 8% into it, and then the eligibility criteria of capitalizing starts from 1st March and the year end is on 31st December. So from March till December is the time when you are going to capitalize this interest cost. So we are going to have 10 by 12. Why? Because January and February, these 2 months we are not going to capitalize. They are 12 months in a year. 2 months we are not going to capitalize. The remaining months are 10 months. Done. So this is going to be into 0.08 into 10 by 12. We have 160,000 as the interest cost. Now, this is the interest cost, right? We have to less investment income. As far as the investment income is concerned, we had a surplus of 1 million, which was not utilized. Done. 1 million was not utilized and it was invested at 6%. For how long? It was invested till 1st July. It was invested till 1st July. So from March till July, calculate the time period. March, April, May, June. From 1st July, we start to use it. March, April, May, June. From 1st July, we started using it. So we have 4 months where it was invested, right? So we are going to have 4 by 12 because 6% is the interest rate for the whole year now. So we are going to take the 4 months which have been used. So we are going to have 1 million into 0.06 into 4 by 12. We have 20,000. So net interest cost, we have 140,000. So this 140,000 is basically the net interest cost that we have, and that is what we are going to capitalize. So the answer is 140,000. Let's go to our exam kit. This is 140,000, option A. I hope it's clear to you guys. Okay, now we kind of hold up. We had a hold up on this question. Now let's use this question. Okay. Now this question says, Carriageways Company had the following bank loans outstanding during the whole of the 20x8, which form the company's general borrowings for the year. 9% loan, 20x9, repayable for 15 million, then 11% loan, and that is for a total of 24 million. Carriageways Company began construction of a qualifying asset on 1st April 20x8 and withdrew funds of 6 million on that date to fund the construction. On 1st August 20x8, an additional 2 million was withdrawn for the same purpose. Calculate the borrowing cost which can be capitalized in respect of this project for the year ended 31st December 20x8. Now we have multiple sources of loan, like one is at 9% for 15 million, one is at 11% for 24 million. We have these multiple sources of loan with us, and we have used these multiple sources so as to finance the construction of a qualifying asset, or the qualifying, what we can say is a project basically that we have. Now the question comes, we have one interest cost at 9%, one at 11%, and we have used a chunk of amount from these loans. Now, what percentage is to be applied? 9%, 11%, or what to do? In this situation, what do we do? Or the best thing that we can do is we calculate the weighted average cost of the loan. What do? We calculate the weighted average of the cost of the loan. This is what basically we do. And in order to calculate the weighted average, what we will have to do is we will have to calculate the 15 million and the 24 million with the weighted averages, obviously. And we are going to calculate 1% as the cost of the interest as far as this weighted whole average is concerned. Now, in order to calculate the weighted average, what we are going to do is we have 9% loan, the amount is 15 million. Then we have 11% loan, the amount is 24 million. The total is 39 million. Now, the best way to calculate is 9% into 15 by 39, then 11% into 24 by 39. This gives us the weighted averages. This gives us the weighted average of the loan, because we are calculating the 15 by 39. We are calculating the weighted average of this first loan with the overall total percentage. We are calculating the overall total percentage. Now, 0.09 into 15 by 39, we get 0.346, and then we have 0.11 into 24 by 39, we get this, and the total is around 10%, right? The total is around 10%. This into 100, we get, okay, no, we are not going to supposed to multiply the percentage. We're just going to have the percentage at 10%. Done. We have it at 10%. So the total percentage that we have over here is around 10.23 rather. It is at 10 point, let me write it over here, 10.23%. This is the percentage of the loan that we have over here because of the weighted average. Now, first we took 6 million on 1st April, then on 1st August, we took 2 million. So what we can do is we have from 1st April to 31st December, we had 6 million of loan into 10.23% into January, February, and March, 3 months out. And so we have it over here for like around 9 months. This is going to be 9 by 12. Then we had the additional 2 million loan into 10.23% into, we have on the 1st August, now we got this loan. So August, September, October, November, December, 5 months. So this is going to be 5 by 12. So for the first one, we have into 10.23 into 9 by 12. Then 2 million into 10.23 into 5 by 12. We have 85. And then the sum of these is at 545,600. We have 545,600. Now I have to show you something. If you look over here, we don't have any option over here, right? We don't have any option over here. The closest one is 549,333, but we don't have the exact option over here. Why? Why is that? Look here. We have calculated the loan percentage over here at 10.23%, right? We don't have any issue. There's no calculation error whatsoever. Now look here. If I solve this question by having 6 million into 10.3% into 9 by 12, and then 2 million into 10.3% into 5 by 12. Now look here. What happens? Into 10.3 into 9 by 12, then into 10.3 into 5 by 12, then I have the total 549,333, right? And this is the one you are having the answer as over here as option A, 549,333. Actually in exam kit, if you go to the answers, you are going to find this answer 549,333 as option A. And if you go to the solution, you will find the question being solved like this, which is wrong. I'm stressing on this point. You can come across some of the problems, some of the glitches in the exam kit as well, because at the end of the day, this is the humans which we are doing. So technically there can be an error, or there can be a possibility of the error as well. Although the chances and the possibility is very low, but there are some few questions where you are going to find the errors, because the percentage which we calculated is basically at 10.23. It's not 10.3, it's 10.23. Have it been like, at like 10.25 or 26, then we could have rounded off at 10.3. But rounding it off at 10.3 instead of 10.23, it is wrong, and it is calculated wrongly in the exam kit. The actual answer is 545,600, but due to an error in the exam kit, the answer is stating at 549,333, not at 545. That's why I just kept this question for the last, just to ensure you guys that our calculation is 101% accurate and correct. There is no error whatsoever as far as our calculations are concerned, and this is simple a glitch or an error in the exam kit itself. So you don't have to worry about that. Normally it do happens, and as I've told you, and as I've shown you, this is how basically the question is going to be solved. Done. I hope it's clear to you guys. Now we have seen 3 questions from the exam kit as well. We have kind of discussed those questions as well. Now it's time to go back to our, let me first open one portion of the screen, and here we go. Okay. So we were into the capitalizing of the borrowing cost, which we have just discussed and we have just talked about. And that is basically we have to capitalize the interest cost. And that interest cost is going to be capitalized as on the rules that the loan is explicitly used for the construction, and the capitalizing of the interest costs begins when the actual construction on the work on the asset is started or begin, and it ceases to capitalize once the asset is available for use. Not when the asset is used, but when basically the asset is available for use. Moving ahead from here, now you have the subsequent valuation. We have the subsequent valuation, and it allows you to use the cost model or the revaluation model for the tangible non-current asset. And then the same model must be used for all the assets in the same category. And when the revaluation model is used, you have to revalue the asset regularly. We have the revaluation gain or loss. Then we have the revalued amount of the asset. And then technically we have this sort of information over here. Now, let's just go back to our Word. And now let's just talk over here. Subsequent my event. Subsequently, all non-current assets can be measured by using any of the 2 following models. 1, cost model. 2, fair value model. Now we have the cost model, that is, the asset is reported at its carrying value. Now, carrying value is cost minus accumulated depreciation. Depreciation in normal terms, it's called wear and tear. It's called decrease in the value of an asset due to its usage only. Depreciation is wear and tear. It is the decrease in the value of an asset due to its usage only. I have stressed on the word only by saying that it is going to be the decrease in the value of an asset due to its usage, due to its use. And if we talk about the definition, it is the systematic allocation of the cost of an asset to income statement according to its usage on a pro rata basis. It is the systematic allocation of the cost of an asset to income statement according to its usage on a pro rata basis. That is that systematic way available to you by which you charge the cost of an asset to income statement according to the way you have used the asset. Methods of calculating depreciation. One is straight line method. One is reducing balance method. In International Accounting Standards 16, IAS 16, we have these two methods to calculate the depreciation. One is called the straight line, one is called the reducing balance method. If we talk about the straight line method, it says cost minus scrap value divided by useful life. And we can have, apart from the scrap value, we can call it the residual value as well. We have talked about, okay, we will talk about it later. We get an amount for the depreciation. And now let's just have some boxes over here so as to get an idea that what is what. Scrap value, then we have useful life, and then we have this amount, and then we have okay, scrap value or the residual value, the value at which management expects to sell the asset at the end of its useful life. The value at which management expects to sell the asset at the end of its useful life. The useful life, the time period or years over which the asset will be used. And then this is the fixed depreciation charge per year for every year. Okay, so we have the formula of the straight line, and it is called as the cost minus scrap value or the residual value divided by the useful life. We get a fixed depreciation charge per year for every year. In straight line, we just calculate the depreciation charge for once, and that same charge is basically applied and is accounted for same year. I mean, like the same amount is charged every year. Done. So this is what basically uh, the depreciation charge under the straight line method is. Scrap value is the value the management is kind of expecting that we will be able to dispose of our asset, we will be able to sell our asset at the end of its useful life. And normally speaking, this is an estimated value. And if you are unable to estimate the value at which you are expecting to sell your asset, and if you are unable to determine it, if you are unable to calculate it, then simply ignore it. You can have it at zero as well. I mean, if you are finding it difficult to estimate the scrap value or something, because it's an estimated value, now you can have it at zero as well. Then useful life, the life is again is an expected time period over which the asset is going to be used for. Done. Now, talking about and why am I unable to click over here? Uh-oh. Okay. Let's have an example. Suppose the cost is 100,000. Let's just write an example. The cost of the asset is 100,000. Life is 10 years and residual value is 10,000. The asset is depreciated over its useful life by using straight line method. Calculate depreciation charge per year. So this is going to be 100,000 cost minus 10,000 scrap value divided by useful life of 10 years. You are going to have 9,000 depreciation charge per year for every year. You are going to have 9,000 depreciation charge per year for every year. This is what the straight line is. Then we have a reducing balance method. The reducing balance method says the formula is cost minus accumulated depreciation is equal to carrying value, and you multiply percentage of depreciation with that to get depreciation charge for a specific year. You get a depreciation charge for a specific year. Let's have an example. Suppose the cost of an asset is 100,000. It is depreciated at 10% per year using reducing balance method. Calculate depreciation charge per year. Now, year one, we have the cost minus accumulated depreciation, right? So the cost is 100,000. Accumulated depreciation, the depreciation which we accumulate, which you kind of like add up together for the whole years. So technically, if you have just bought the asset, so technically for this asset, there's no depreciation beforehand. There's no accumulated depreciation beforehand because technically this asset was not with you in the start. You have just got this asset, so there's no accumulated depreciation whatsoever related to this. So the accumulated depreciation is going to be 0. So 100,000 minus 0, you get the carrying value at 100,000 into 10% of the depreciation charge. So you get depreciation of 10,000 for the year one. Then year two, you have 100,000 as the cost minus. Before this, you only have a depreciation of 10,000 with you, na? So the 10,000 will be deducted. You get the carrying value at 90,000. You are going to have the percentage of the depreciation over here. So you are going to have 9,000 as the depreciation charge. Then for year three, now you have 100,000 cost minus accumulated depreciation. Before this, you had the depreciation of these 2 years, the total of which is 19,000. Now you are going to have 81,000 as the total carrying value at 81,000. You are going to have it at 8,100. Then at year 4, you have 100,000 minus 27,100 as the total. And I'm not good at basic maths, so I have to rely on the calculator. we have it at 72,900 into 10%. So we have it at 7290. Now look, every year 10,000, 9,000, 8,100, 7290, the depreciation is dropping, right? So this drop in depreciation is kind of like, made the name of this depreciation method being called as the reducing balance method. So this is what we have over here as far as the depreciation methods are concerned. Okay, now we have the bit of accounts as well that we are supposed to make in this, like the cost account accumulated and the disposal account as well. We have to talk about that as well. But I guess what I do kind of feel is that we should stop over here for today. We should stop over here for today because technically when we talk about the accounts and all, then obviously we will have to do some multiple adjustments and some questions in order to understand. So it will take a bit of an extra time, which I don't want to in the very first lecture, because I just don't want to put an extra pressure on you guys. It's just that what do you have to think and what do you have to keep in your mind is this is what basically the approach is going to be as far as this whole the standards concerned. Okay, now the thing is, whatever we have solved on the Word file, the Excel file, along with the PowerPoint file, these are going to be shared with you at the portal as well. I'll make sure that as soon as I'm done with the class, I upload the files over there at the portal so that you guys can have an access of these files from there so that you can easily solve these. Meanwhile, as far as today's class is concerned, any input, any feedback, or any suggestion that you want to give as far as today's class is concerned? I mean, any suggestion that you think that it should be there or it should be done in this way that can make the class more interactive and more fruitful, you guys are more than welcome to share. Let's just start with Lois. You, any suggestion you want to give for the classes for the coming in the future as well? What do you say?
No, I think it's really good for now. So we have the notes, we have the presentation of the work that you're doing, and yeah, I think it's good.
Okay,
Just
because
a just a
yeah,
little bit of internet problem, that's all. From your side, sometimes the word just breaks out. So yeah,
okay. Okay, the
we
thing is
fix.
basically today I was not at my home. I'm at my relatives, so that's why at my place normally there's no internet issue basically, and basically there are so many kids over here as well, because we kind of had a small get together over here. So I'm just locked. I've just locked myself into a room where nobody's allowed to come in. During my class, actually there are so many kids and they all are using the gadgets at the moment, and so technically there is a pressure on the internet, and this is something I do consider as well because I was kind of having a pop-up on the screen, the instability of the connection basically. So I know this had been
Yeah.
an issue today, and definitely for sure for I'm 110% sure that it will be resolved in the next class, definitely for sure. Okay, apart from the internet, you think that everything is fine? We have done the exam kit as well today. We have covered some of the examples as well, and we have been doing some work on the word as well. So you are satisfied, right?
Yes, sir. So I think it's good approach when you're depicting the theory and telling that with some questions, back it out with some questions. So yeah, it's better to
Okay, okay.
understand like this.
Okay, okay. I got your point. Thank you. Okay, Ms. Sophie, what do you say?
Explanation is good, approach is correct. Overall, good explanation, but a small suggestion from my part, maybe it's my opinion, after a question asking us if it is correct or not. In my opinion,
The question is what? I don't get your point. Last one.
I say overall is very good. Explanation is clear. I have well understand everything. In my
Mhm.
opinion, even if I have understand the question, it was very clear. In my opinion, it would be better or good to ask whether we have understand after each question. in my opinion.
Okay, okay. But I kept on asking, I kept on saying that I hope it's clear to you guys. I mean, this is a statement I normally use very often. And
Mm-hmm.
yeah, you're right. I explicitly didn't ask both of you regarding if you are clear or not. But this is something, you know, I had taken up an assumption that if something is not clear or something, either you guys are going to raise the hand or you guys are going to just unmute yourself and ask. I kind of had that assumption with me.
Yes, it was good. All I have understand.
Okay, okay, okay. So as far as you think you are suggesting that after every example or question, I should ask that if it's clear to you not or if it's clear to you or not, right?
Not every example or question, maybe for some long questions. It
Obviously,
just
obviously it's going to be there. And one more thing, I like your suggestion. I am very much going to have it into, like, my mind next time when we are having the class. But again, one thing I want to make sure, and I want to clear from my side, and that is, guys, if I am explaining even the theory, even the question, and you guys are unable to get it, like Lavish, you said my voice broke up like multiple times when I was explaining. So in that time, if you happen to lose about what I just said, rather than waiting and all, you are just going to unmute yourself and you are going to stop me, and you are going to say that, sir, there's a bit of a problem regarding the connection and you are unable to hear. And I'll be more than happy to, repeat my sentence over there. Because like this, maybe there can be a possibility even in the future when I am at my own place, that maybe there can be a bit of a fluctuation of the connection. It can be at my end, it can be at your end as well. So you don't have to, wait, or you don't have to get into any some formality or something. You just unmute yourself, or if you think rather than muting, you can raise your hand as well. And I'm always, continuously monitoring the screen while teaching, and while, delivering the concept, that if there is any pop-up on the screen or something, so that I may help you guys. Okay, but I like your Miss Sophia, I like your suggestion as well. I'll definitely keep that in my mind. And during the course as well, as far as this whole F7 is concerned, my approach, obviously, this was the start where a bit of a discussion is very much required as far as the IS16 is concerned. Because if I see at the weightage of this standard overall into the whole paper, at least from 15 to 25 marks of the paper, from 15 to 25 marks of the paper is from IAS 16, is from this standard. So that is why I am kind of very much into the details. I'm very much into the theory as well. And secondly, I took an assumption, and I'm going to have this assumption with me at all times, that you guys don't know anything about the accounting. This is the assumption I'm going to take, because I have to make sure at every point, at every corner, that you are having the concept, you are getting the idea as far as the double entry is concerned as well. Because at the end of the day, these are the accounts that we will be making. And if we are not, strong, and we don't have a solid grip on the double entry, obviously we won't be able to get an idea regarding the future standards as well, what we are going to have. So I'm going to, keep on doing that as well. And I really enjoyed today, having my whole discussion and class with both of you. And I'm happy that you guys are kind of, interacting as well, and I look forward to it with the same habit, that you guys keep on, answering my questions. You keep on involving yourself in the discussion as well. Because, you know the one way teaching is when the teacher is speaking, the students are only listening. Even the teacher do gets bored at time. So it's a healthy thing if you keep on, indulge yourself into the discussion. I'm kind of asking, you are kind of asking, we are into the cross questioning and answering. By this is a healthy environment, and only by this we can make sure and ensure that everything is properly, and, in an effective manner, it has been covered in the class. Okay. So I look forward to it as well again. So I guess this is all from my side. So take very good care of yourself. Enjoy the long weekend ahead of you, and then the weekend as well. Take very good care of yourself, because I know the pandemic situation over there is not kind of good, but still it's kind of improving and all. But let's hope everyone is safe. Keep yourself, your family safe as well. I will be uploading these whole files to the portal as well, so that you can have the access from there as well. Plus, I have sent to the coordinator my volume 1 and volume 2 of the accounting standard notes as well, so you can have them. Maybe if you have the access to the portal, maybe you have them right now with you, or in the morning, maximum by tomorrow, you will have all the resources that you need for this paper. And the WhatsApp group is going to be created as well, so if anything is being kind of missed from my side, maybe say in case if I forgot to upload the notes, or if I'm kind of like late in uploading the notes, you can drop the message on the WhatsApp just as a reminder that we are still waiting for the lecture and all. You will have the video lectures as well, the video of the whole class, so that if somehow some way you want to recheck that what was being discussed in the class or something, you can access the video and you can do the work from there as well. So that's all. Thank you for joining today, and definitely we are going to meet next Friday. Till then, it's bye bye.
Thank you, sir.
Thank you, sir. Bye bye.